so for this next section, this was the question that was received. So we really are looking here at the interplay between fringe benefits and allowances. And I want to give you for a moment the chance to read the question properly. So what I like about this particular question is that I think it's a great opportunity to go and remind us again of the fact that we need to always remember that when we're dealing with tax, the individual, the shareholder, the director, and the company wear different hats, but also most importantly, the shareholder and the company are two separate taxpayers. And when it comes to deductibility, is that even though we may objectively or in our management style think of the company and the shareholder as being interchangeable, from a legal point of view, they're not. So our core issue here is really the fact that legally, the company doesn't own the vehicle. The shareholder does, or the director does, or the employee does, whatever hat that particular individual is wearing at this point in time. What that means for us practically is that when we are looking at the expenses related to the vehicle's owned by the individual, therefore the expenses belong to the individual. So the company actually has no liability for those expenses, because they do not belong to the company. The car is the individual's, therefore legally the individual is liable. So we always need to then go and take the step back and go and say, if we want to make the business responsible or the company responsible for the vehicle costs of the individual, how are we going to do that? And realistically, we essentially have three options, one of which is really not very practical, and two of which are most common. Option 3, the one I'm going to discount immediately, almost immediately, is that the company rents the vehicle from the individual. And the reason I say that's not really practical is because if you think through the logic, it means I receive rental income, my company pays rental expense, but then I go back and receive a fringe benefit for the use of the vehicle again. So it's overly complex. So realistically, the only other two options I would have is fringe benefit or travel allowance. Now, a fringe benefit, though, implies that the company has made something available for my use. If it's my vehicle which I'm using, it can't ever be a fringe benefit, though. So my only real option is travel allowance. So the only way I as an individual can really be reimbursed for the cost of using my vehicle for business purposes is if the company, my employer, pays me a travel allowance. Because that's the only way the company gets or the business gets a legally enforceable expense related to the deductibility or that becomes deductible for the business. And that travel allowance could either be a fixed amount, it could be the company taking over responsibility for paying the expenses. It can take a variety of different forms. That's not the point. The point is that legally, it's my vehicle. So the company must have an agreement with me to say, I will bear a portion of your costs because you are using your personal vehicle in order for the company to actually have a deductible expense. So the short answer here is that if I use my vehicle, my personal vehicle for business travel, company actually gets no deduction unless they agree to compensate me for the business travel. Okay, what are the requirements for that? As I say, then what is the value of the allowance? Right. So that's always going to be your trade-off. Is whatever the company pays becomes deductible in the company's point of view. And here we don't even need, from the company's point of view, we really don't actually need that much in the form of detailed documentation to allow for the deduction. Something as simple as an employment policy or a claim sheet from the employee to go and say, hi, please compensate me for my travel costs, and an appropriate authorization by someone within the business would make that amount deductible for the company. But the trade-off is what I've got next there on the screen, is that realistically, by it becoming deductible for the company, it means it becomes a taxable allowance for the director, and the director is going to have to take the tax hit. If we want no tax consequence for the director, then it means that the company gets no deductible expenses. You need to pick your poison. Right. Admittedly, in the scenario where the most tax-efficient scenario would be for the company to pay an allowance to the individual. The reasoning being is because the company would get, there is a legitimate business expense here. So the company would get a deduction for whatever it pays the employee. No paperwork required other than basically recording it as PAYE for the employee on the RP5 for the employee. The employee, however, then when they go and do their income tax return, would have to go and reflect, and then it would have to follow the normal travel allowance principles. If it was a reimbursable allowance, you wouldn't have to go and show anything because it would be exempt as long as the rate per kilometre was below the approved $4.18. If, however, it's a fixed allowance or it goes above the $4.18 or it's variable or there's something else that's not just fixed rate per kilometre to it, then what I would have to do in my books is I'd have to accept the fact that my employer would treat that allowance as taxable. The employer would withhold PAYE, and then when I do my tax return, I would be able to claim a deduction for the business travel that I've done using either my actual or the fixed table costs for travel allowance, the deemed costs that we can then use to go and claim a deduction for. So from a business point of view, this is actually a fairly simple question. But often we don't like the answer because we have a tendency to not think of the shareholder and the company as separate legal entities. We think of them as one and the same. So please be very careful with this. Ensure that you are very clear on the criteria, also to your directors and to your other staff, that they understand the fact that there's a trade-off. If the vehicle belongs to the individual, company gets no deduction unless they pay an allowance, which then brings tax consequences back to the individual.